Welcome to Tracking Trends with me, Nikunj Dalmia, the show on which we'll identify big trends, we'll debate them, we'll really break it down for our viewers, then we'll try and make sense of it, whether this trend is worth participating in or whether this trend is something where the risk-reward ratio is not that favorable. Now, the party in the stock market continues. I'm using the word party on purpose because this party started just before Diwali and looks like it'll continue well into the Christmas season as well. BJP Assembly poll hat-trick is having impact on the market. Say Nifty has crossed 20,600 on expected lines. Adani group of stocks, they charge the rally up. Sectoral leaders include financial and realty, and they've gained over 1% gain across the board, barring pharma and media. And HPCL and BPCL along with IOC, which is oil marketing stocks, they've also hit a 52-week high. Obviously, there is a huge buzz as to where reforms are likely to move and things are moving on the PSU oil front. Now, the points and the trends which we are going to be debating in the next half an hour on this edition of Tracking Trends with Nikunj Dalmia. Is it time to move from small cap to mid cap? That's trend number one. Trend number two, OMCs are still looking cheap, and is it a case to still jump on the bandwagon? But first to our big point, which is time to move into, or time to perhaps rather move out of small cap stocks. And I would stick my neck out and say, if not fully, if not completely, then partially. It could be a judgment call whether you want to move 15% of your allocation, 20% of your allocation, but I feel that it's time now to change gears. And some of those high-flying mid-cap stocks which are running at the rate of a rabbit, I think it's time to sell or shift gears and bet on the large-cap tortoise. Why am I saying that? Well, a very basic benchmark is that you look at P multiples. And P multiples in large-cap stocks, as we speak, 12-month forward, are trading way above their average, way above their 5-year average, way above their 3-year average. But that is not the story in large cap stocks. Nifty 50 is in and around large cap stocks. The earnings cycle between last 3-year and 5-year is more superior for large cap stocks and not that superior for mid cap stocks. Similarly, for mid cap stock, 12-month forward, P multiples 25 times, which actually is now way above its 5-year average. And I'm not even getting into small cap stocks. So if one really looks at this very basic parameter, which is that is it time to move out of large cap stocks and move into mid cap stocks? Well, the answer to that really could be a well yes when it comes to asset allocation. Now in markets, well, money is always made when you look at the right asset allocation, and the right asset allocation of the recent run-up would be this. Look at large cap stocks and where they are, both in terms of the P multiples and also in terms of the large cap focus. HDFC Bank, Reliance, Infosys, some of these stocks are now available at multi-month lows. And that I think is the most important point, that when large cap stocks are available at a multi-month low, it's maybe time now to look at some of those stocks. So Kunal is standing by, and Kunal has done some great analysis. So I'm just going to walk up to Kunal and talk about, what the election cycle is, how the election cycle could be interpreted. So Kunal, if history is anything to go by, 2004 onwards, 2004, 2003, that's the large cap weightage, but I just want to bring the election cycle.
Correct.
Nifty in 1999, 6 months ahead of the election, 36%, 2004,
correct,
9%, when it was given that BJP was coming.
Yes.
Yet market rallied.
Yes, market rallied.
2009, we came off that 2008 GFC crisis.
Surprise, yes.
2014, अब की बार मोदी सरकार.
Correct.
And फिर से एक बार मोदी सरकार, yet markets rallied.
Yes.
और hat-trick मोदी सरकार, can the market rally again?
In fact, the analysis is quite interesting because we'll concentrate more on 2014 and 19, where the markets first were taken by surprise. We moved on to 19% 6 months prior to the elections, 1 month post the elections, and 6 months post the elections. The data is extremely positive in these two aspects particularly, which means 2014 prior to the election, 6 months prior, we were up 19% on the index. 2019 we were 11% on the index. What happened 1 month from there? 2014 we were positive on the index by double digits. 2019 we were just up 1% to 2% broadly on the index because we went through a bit of a saturation on the indices. But the data in the next 6 months is extremely positive for both of these counts as well. So what this tells you, the way in which markets enters into the results the election results is the way in which the market exits after that 6 months of results.
Now, Kunal, Nifty has rallied anywhere between, now this is anywhere between 9 to 38%.
Correct.
That's a very long kind of range. So where do you think this range will settle for this time?
So I would look out for somewhere closer to this double digit. So maybe an 8 to 9% averaging out. If you look at this over here, so even if you do a simple average, it's around 8% approximately. So the way in which the markets have entered in the last 6 months, amidst all of that global negativity, etc., we're still up some 7% to 8% broadly on the Nifty.
12% is what I saw. YTD.
Yeah, so I'm looking at it from the October low specifically because that's where the major turnaround is for the indices. And now going forward, I would believe a similar kind of a percentage is what we can expect from current levels.
But Kunal, interestingly, now let's look at this is 6 months after.
6 months after the election results.
Now 6 months after also in 2014 the gain sustained.
Correct.
2019 the gain did not sustain. I mean 2% is actually hardly a return. So what are the chances that a 2019 pre-market rally and a post-market dampener could be at play this year?
Very interesting question, Nikunj, but I believe frankly that this may not happen this time. I mean, this number may not happen this time around. And the clear reason for that is, as you were mentioning, large cap underperformance. Yeah. So we did not have large caps participating in this last entire 2000 point rally. And now we have large caps which have started to blossom, which means that, the good part of the market rally is still ahead in front of us.
As a marker, and tell me out of the 3 stocks here, which would be the strongest one? Which would be the strongest one if one has to rally on a pre-election rally?
See, I would bet on, I'll maybe pick 2. I'll bet on this and I'll bet on this.
Okay, so Kunal feels that if you are looking at a pre-election rally, then you got to go back for basics. Basics is you go for a heavyweight, which in a sense is a bet on Bharat, that is HDFC Bank, and then you bet on the new Bharat, which is ICICI Bank.
Absolutely.
So both in this case, they are actually giving you insurance.
Correct.
They are giving you retail banking. They are giving you a play really on lending, and they are giving you a play on how India is going to move. So bet on the Bharat and bet on the new Bharat. Just bet on banks and keep it very simple.
Exactly.
Okay, I'm going to flip it around and talk about valuations, Kunal. And just to get in a perspective here, I may sound slightly repetitive with this one, but the point we're trying to make here, Kunal, is that prepare yourself for a rally. But maybe the best way to participate in that rally is to take some chips off the table, not chips off the table in this case, ampute some part of your small and mid cap portfolio. Now, Kunal, maybe you want to use a marker again here. Me and Kunal are, by the way, sharing a marker. That's a bro bond we have, right? So, Kunal, this is the point we are trying to make here. Look, Nifty is trading just in line with its 5-year average.
Correct.
Earnings in last 5 years were subdued. Now earnings are in full bloom.
Yes.
Small cap index is trading way above its 12-month. It's 3-year average and 5-year average. So, word margin of safety, I think, is here.
It's more towards here, yes.
Right? And can I, if may just, so guys, just remember this. I'm just going to make this point here. This is a 5-year average for the small cap index. This is the current average, which means you're trading at a premium. And that premium is unlikely to sustain.
Correct.
So my limited point here is that right now, bet on the market uptrend. Kunal feels that the market would rally into the run-up to the election. And because the starting point, if it is today, valuations in large cap stocks are attractive. So that is what you should be bet on. But if you don't have cash, maybe take 15-20% chips on the table, off the table in the small cap index.
Yeah,
and
absolutely.
Then
I think it's a very good time to try and book out profits over here and shift the money back towards here. In fact, a classical day like today, where the small caps and mid caps are relatively not doing well. I'm talking of it as a portfolio perspective, but the large caps are doing exceptionally well today.
So let's high five on that. Thank you very much. It's just been, gate reckoning. And I'm just going to go back to my seat. Taking the pen by the way. Go back to my seat, and here's an excerpt of our conversation with Swaminathan Ankleshwar Raya Swami, or the author of Swanomics, and we actually spoke to him pretty much the same thing, that based on the outcome of the assembly election, how should one really read into what could be the mandate 2024?
Yeah, I would say from the point of view of, I can understand Indian investors getting a little more charged up with this, but the foreign investors have already built in the notion that Modi is getting re-elected in 2024. That being the case, they don't really see that the state election would have changed things very much. Even if the BJP had done somewhat worse and lost a state or two, I don't think for a minute they believe that Modi will not return very, very solidly. That's why I thought that, foreign markets may not get charged up by this news. It's already built into their expectations.
Suresh, the question which we are addressing and debating and deliberating, I think I asked you this in the morning, but no harm in repeating the same again. Stay with the trend. Trend is your friend. Trend is on the upside. The direction and the momentum, I think, is quite pronounced. But when you have to choose the opportunity cost versus risk, is it time to take 15, 20, even 25% profits off the table from small and mid cap stocks and simply park them in large cap stocks?
So there are two parts to when you take a cash call or you take a call of shifting. So it's not just about shifting, say one can go on 20% cash, but the real call is, will you be able to deploy the same money back on a decline? Or when do you take the call to again move back to small caps? And in that case, the optimization is not huge. Say, for example, even if you expect a 10% correction and you've pulled out 20% from your mid cap, small caps, you will save something like 2%. And maybe your, say, large caps do not fall much. But if you don't deploy, by the time in the next 6 to 12 months, if the small caps and mid caps do well, and some of your stocks in that basket which you removed could actually go much more. So one has to stick to the asset allocation unless and until one is very, very cautious about the markets, wherein say if you think it is as crazy as a 2007 or a 2017, which I think we are not there. Say the last 2 year returns are not great on the benchmark indices itself. We were at 18,000 levels in 2021, and we are still not even at 21,000 after 2.5 years roughly. So the view is stick to the same allocation, and if you want to shift to it, be ready to again take a call maybe a couple of months or 6 months down the line to again get back into small caps and mid caps.
Let's take a break. When we come back, we'll talk about oil marketing companies, OMCs. Why are they moving higher? What is fueling them? Are they cheap? And has the tide really turned for the entire space? Alright guys, we've got a nice little rally which has kicked in some of the oil marketing companies. And why is it? Is it pure interplay of valuation versus underperformance? Or markets are now convinced that a strong BJP victory in state means that oil is something which up until now, the spirit of deregulation has not been followed. That would be done in totality. So what is driving some of these stocks up? For a neat preview of that, let's go to Somit.
Well, the three oil marketing companies, that is BPCL, HPCL and Indian Oil, now they are all buzzing into it, and this is post BJP's strong show in state elections has actually calmed the street and calmed the fears of populist moves that we usually see coming in ahead of the general elections. Now, so one part of the street is now believing that there won't be any harsh populist moves that the government might take ahead of the general elections, and because of this, now street also believes that the oil marketing companies might not be asked by the government to lower retail fuel prices, that is petrol and diesel prices, ahead of elections, given the fact that crude oil is now trading at around $80 to $82 per barrel level, as against the $97 per barrel that we had seen a month back. Now, because of this, the gross marketing margins that the oil marketing companies would earn would continue to remain stable and on the higher end, that is around 10 rupees and 3 rupees that they are currently earning on selling every liter of petrol and diesel. Now, this gross marketing margin that the oil marketing companies are earning are much ahead of or higher compared to their earlier averages. So that is the one positive thing coming in here. Apart from this, the other fact is that the Singapore gross refining margin is also pretty much stable around the $6.5 to $7 per barrel mark, which means that both not only the refining marketing segment but also the refining segment would put up a strong show in the third quarter of FY24. And last but not the least, the valuations of all the oil marketing companies are still below their 5-year averages. Now, for HPCL, if you see their 12-month forward valuation stands at close to 5.3 times as against 5.7 times, that's the 5-year average. Similarly, for BPCL and Indian Oil Corporation also, the 12-month forward valuations are on the lower side compared to what their 5-year averages are. So lower valuations, strong refining and strong marketing segment performance are the reasons why oil marketing companies are buzzing in trade.
Viewer query just on that. So what are the expectations, with expectations of near-term uncertainty, political uncertainty out of the way, is there a case to invest in OMCs, or should one stick to holistic bets like Reliance? If OMCs, then which one can one buy based on fundamentals? That's a question coming from Gaurang R from Delhi. So thank you very much for that question. And that is the moot point today. And I'll take that question and throw it right away, right at our expert, Sanjeev Bhasin. Bhasin Saab, good afternoon. How was the lunch today? क्या खाया?
सुपर लंच. और आपके साथ बॉम्बे में और भी बढ़िया लंच करेंगे आपके साथ जो वड़ा पाव खाएंगे.
जी हाँ, वड़ा पाव and look forward even to पाव भाजी. पर छोला भटूरा लेकर आना जब आओगे.
100% छोला भटूरा और रसमलाई दोनों चीजें लेके आऊंगा.
Well, for investors today, it's bit of everything. Best of Bombay and best of Delhi. Unexpected good news is sparking some of the oil marketing stocks. So let's address this viewer query. Is it time to buy oil marketing stocks? Because there is true value in some of these stocks. Sanjeev Bhasin.
So Nikunj, I have been of the view that the Russian crisis was the biggest positive point for all the three oil marketing companies. They were getting crude at a 50% discount, and they refine both hard and soft crude, which Reliance just does one part. So they were actually raking in the money, and you see the quarterly results, particularly from HP and IOC, they have been standout. I still think there is a lot of room on the upside, and now with this, Damocles sword hanging, that there will be some freebies, that is now out of the question. The hallmark of this government has actually been that they did not do anything, to upset the balance on the fiscal side for the oil marketing companies. Now I think the realizations are coming. However, we are aware that the HP, BP, IOC have run up about 30% in the last maybe 2 months, maybe more than that. So doing a SIP is not back, or like I told you, buying a CPSE ETF. But I still think there is a lot of valuation comfort in all these three stocks.
My next question, sir, is this the right time to enter Adani stocks? If yes, which one? That question is coming from Rajesh Talwar. So Rajesh, thank you very much for that question. So, Bhasin Saab, not only today, but from last week, which is last Tuesday, most of the Adani stocks have appreciated anywhere between 5 to about 15%. While markets try to, have this umbilical cord when it comes to Adani group of stocks and the stability of the political regime, that's the market perception. Reality may be different, but purely for an investor. And what should Rajesh do? Should he buy into Adani group of stocks after the recent rally? If yes, which one?
So I've been, answering this query from the last 7-8 months when, in January, February, this crisis escalated. And I said, on a business perspective and outlook, Adani Ports and Ambuja are the two best stocks to buy. And those stocks have done very, very well. Even day before yesterday, if you recall, on Friday, your query was on Adani, and I had suggested Adani Port because arguably it's the third largest port in the world and doing extremely well. Plus the Baltic Freight Index is doing well. And I think on a business perspective, don't cloud it with the political and business look. There is a lot of room on the upside in the sense that the business is performing very well on Adani Ports. Ambuja becomes a no-brainer given that now it is, that their rollover or the cost of money has been also balanced. They've repaid a large part of the leverage. And I think Ambuja is the best play on the port side or the, inland transport side, which they have as a cost advantage for the logistics. So both are buys. However, they have moved up. So buy some now and buy for a decline. Look for a decline to enter some more in both these Adani stocks.
Thank you very much, Sanjeev Bhasin, for that. That's it on this edition of Tracking Trends, Making Sense of Macro and Markets with me, Nikunj Dalmia. But we really appreciate your questions. We really appreciate your queries. The two things which we discussed and ideated in this edition of Tracking Trends. One, is it time to switch some of your gains from small and mid-cap stocks? The answer to that will be a yes. OMCs, is it just more than hot air? Well, looks like it, because this time around markets are convinced that the policy regime for this sector also is likely to improve. So thank you for tuning in, and thank you for watching the show.